The information, opinions, and recommendations presented in this podcast are for general information only, and any reliance on the information provided in this podcast is done at your own risk. This podcast should not be considered professional advice. Please consult your tax advisor, even if it's us, to find out how this may apply to your specific situation.
Hey listeners, and welcome to Tax Trails. Today, we have the next episode in our series on entity types, which we'll be talking about partnerships. Here are your hosts, Derek and Spencer.
Thanks, Chandler.
Thank you, Chandler.
All right. A couple of important dates for you. Beneficial ownership reporting due January 1st. That's something we haven't really talked about before. There was some discussion whether or not CPAs can advise on beneficial ownership reporting. The general consensus is now that we can. So anyways, for businesses that need to get those filed, they're due by January 1st, 2025, and we will likely be doing an episode about what that entails at a future date. Additionally, time to start thinking about making those pass-through entity tax payments. Most states that have them require a payment to be made by the end of the year. Mm-hmm. So especially applicable here in Utah, that's the case. And then also generally a good time to start looking at your end of year taxable income calculations, get those estimates done before the end of the year so you can be ready for tax season next year.
Yeah,
man.
It's flying by.
It's flying by and never stops.
It's a one continuous cycle.
Yeah. So, all right, Spencer, kick us off.
Yeah, so partnerships. We are sorry for making this so late. We had one already recorded, but it ended up being over an hour long. And so we were like, let's kind of just revisit this, and the extension deadline came and we all got pretty busy. So better late than never, I guess. But we're going to be talking about partnerships today. And the first thing that we kind of wanted to go through is answering the question of what is a partnership. And I'm just going to read what the IRS says on their IRS website. We'll have the links to some IRS websites in our show notes, but we're just going to quote in what the IRS says, and they say, a partnership is the relationship between two or more people to do trade or business. Each person contributes money, property, labor, or skill, and shares in the profits and losses of the business. That's pretty much a basic definition of
I like that definition.
What a partnership is. And the requirements of a partnership is that a partnership must file an annual information return, so to report the income, deductions, gains, losses, and et cetera from its operations. And you might be thinking, well, what is an information return? So it files a 1065, and the reason why they call it an information return, and one of the reasons why people like partnerships is because it's called it's a flow-through entity, which we've briefly talked on in prior episodes, where you file this tax return, this 1065, and it's an information return sent to the IRS to let them know the income and all the things that I just talked about. And then that gets reported actually on your personal return, or if a C Corp has it on their C Corp return. But anyway, so you have to file an annual information return, engage in the active conduct of a business, operate with a profit motive, and have two or more owners.
Yeah.
So it's pretty cut and dry on what really is a partnership. It's those things and the requirements that they have, which you can kind of see how that differs from a sole prop.
Yeah. So a sole prop, basically the difference between a sole prop and a partnership is two or more people. So two or more partners, really, because a partner doesn't have to necessarily be an individual, right, in a partnership.
Correct.
It could be another partnership, a C Corp, a trust, whatever. Mm-hmm. So, but then also a partnership, you report a full set of financials in theory. It's not always required to report a balance sheet on a 1065, but versus on a Schedule C, a sole proprietorship, all you're reporting is income and loss, income and expense.
Yeah, there's not even like a section for a balance sheet on there, but
exactly. And then there are separate filing requirements. So 1065 has separate due dates, and
Separate forms like a Schedule K and all that stuff.
exactly. Yep. Yep. So those are your main differences, and you know, sometimes people might think, oh, I've got an LLC. Do I have a partnership? Well, you need to go back and look at, is it a partnership? Do I have two or more partners?
Yeah.
And so some people have an LLC that's filed as a sole proprietorship. Some have an LLC that's filed as a partnership. And so that can be maybe confusing, but
Yeah. Whenever you hear just the LLC, you're
the LLC, it's one of those, it's like a tax Twitter, tax TikTok, you know, hot button buzzword, like LLC. I can now deduct my life. No.
But you have to decide how like what your LLC is going to be taxed as.
Yeah. The IRS doesn't really consider an LLC to be anything. So it's not
It's not a tax entity.
exactly. But it often gets lumped in with them. So anyway, that's kind of fun.
Yeah. Well, kind of going off of that, there's
Yeah.
there's different types of partnerships.
Yes.
LLC being one of them. There's also general partnership. There's limited partnership. There's limited liability partnership. There's a couple others that I didn't mention. Those four are pretty much the most
Yeah.
commonly used partnerships. And really, the biggest difference between those just comes from who takes on the liability of the company. All but the general partnership also has some additional setup where you have to file. You might have to file some different legal documents with the state, and so on. And so those are just kind of that's just a high level overview of the types of partnerships. If you want to get more into the nitty gritty of those partnerships, those again are more for legal structure, and so it would be best to talk to an attorney or someone who practices business law who can help you answer your questions specifically on how to set up these partnerships legally.
Yeah. Yeah. As tax accountants, that's actually one of the things we are often recommending. Like, right. We do not specialize in necessarily entity setup and organization. Like that's not what we do. We can recommend what type you might want to look for, but we often will recommend, hey, you might want to do this, but you need to go work with an attorney to get this set up appropriately.
Yeah.
And so that's something that needs to be considered when making a decision on what entity type.
Yeah, but no matter what entity type you do choose, what type of partnership, it's all going to be taxed essentially the same, right?
Yeah. Yep. Exactly. So moving on. Yeah. So how is the income taxed on a 1065? So like Spencer mentioned, the 1065 for federal purposes does not pay income tax. That is not what it does. All the income and expense items get broken out and reported on Schedule K and Schedule K1, and we've done an episode on that.
Yeah. So if you want a breakdown of what a Schedule K is and how it affects your K1, we have one that came out earlier this year.
Yep. And essentially, your K1 will get issued to the ultimate owner for their, their share of all the income and expense items, essentially, and whatever activity happened in the partnership that year. And so some of it can be taxed. So on an individual basis, it'll go onto your Schedule E and reported there. There may be interest or capital gains that get reported on different schedules on your 1040. But, essentially it goes and gets taxed to your individual level.
Yeah.
And then the income, the ordinary income, is going to be taxed at ordinary income tax rates, right? Whatever your income tax rate is on your 1040, that's the rate at which your income is going to be taxed from your partnership.
Yeah. Yeah. Which can be nice because they fluctuate, right? So like the brackets, you have a 10, you have a 12%,
Yeah.
22, 24. So some of it might be taxed at that 12%, which is nice. And then some of it would be at the 22.
Yep.
And so on.
Conversely, if you were a proper C Corp, right, your income's just being taxed at 21%. Mm-hmm. And that's all there is to it. So, one other little note. So generally, your income or the activity is going to be allocated just based directly on your ownership percentage. That's a good general rule.
Yeah.
But there are tons of exceptions, and there are lots of reasons why those exceptions exist. And that's also one of the benefits of having a partnership is you can do a lot of unique business structures and incentives for bringing in business partners or doing certain things certain ways, because you can get kind of crazy with how your income gets allocated. Like, for instance, the partnership in general could have had a loss, right? You had $50,000 of income and $100,000 of expenses, but then you could have a partner that's getting income allocated to them and a partner that's getting additional loss allocated to them.
Yeah.
So there, and we're not going to go into that here, but just know that partnerships are really cool. They're flexible. You can do a lot of interesting things to get your business going there.
Yeah, and that's specifically called special allocations. So if you've ever heard that, you're allowed to have special allocations on a partnership. Unlike an S corp, S corps do not allow special allocations, which we will be talking about in our in a future episode about S corps.
Yep.
And there's specific rules that you have to have, but all of that's really for another. And
Yeah.
I mean, that's
Yep.
there's
Just
a lot of
letting
stuff.
you know what's out there.
Yeah,
But
it is possible. It's one of the things, and all the things that we're talking about are pretty much more general, high level things that you should know about a partnership. And so that's one of the things that you should know. Another thing that you should know about, especially how the taxation of a partnership works, how it gets flowed onto your 1040, your personal return. Your income from the partnership is subject to self-employment tax if you are actively involved in business operations. And so, again, we've kind of talked about that before. We had a podcast episode with one of our partners, Craig, who we talked about how partners do not actually receive a W-2.
Yep.
And so the way that the IRS receives Social Security and Medicare and your self-employment tax is because we are taxing I guess I shouldn't say we, because it's not necessarily me who's doing it, but the IRS is going to be taxing your ordinary income of your business with self-employment tax. So it's 15.3% tax calculated on 92.35% of self-employed income. But there's also another tax that you kind of have to be aware of if you're not actively participating in the business.
Yeah, so net investment income tax, and high level, basically what this is, it's an additional 3.8% tax on your share of your business income in the partnership, or largely on your investment income, right? And this really only applies if you're an investor in this partnership, right?
There's specific rules where to be considered active versus passive, or I guess non-passive versus passive, which is again a topic for
there are all sorts of rules and tests you can do to try to figure that out. But really, at the end of the day, you could think of it as, did you just put some money into this thing and you're just looking to get your return? You're an investor, then that is theoretically going to be subject to that net investment income tax. Mm-hmm. Okay, and then also the other thing that you can get, and this is part of TCJA, so theoretically this may go away, but the income from your partnership can go into your qualified business income deduction on your 1040, which is basically you can take 20% of your income and take a deduction for that.
Yeah.
That at the high level.
Yeah.
Again, there are lots of rules and regulations on what applies as qualified business income deduction, but in general,
and there's AGI limits and things of that nature. But at a high level, that's what it is.
Yep, 20% of the income from your partnership you can take as a deduction on your 1040.
Mm-hmm.
So,
and that deduction again will reduce your taxable income.
Yep, it's not a credit.
Yeah, not a credit. Awesome. So, we're kind of looking at that. We're talking a lot about income being taxed, but what about your losses, right? Because not every year you're going to have a loss. And so we kind of wanted to we're going to go through basis and loss capture, because basis helps to, I guess, calculate the amount of loss that you can have in that year. And so first of all, basis. So basis essentially represents your investment in the partnership.
Yeah.
And your initial basis is measured by the amount that you've essentially paid for the interest, whether that's like a fair market value of the service, net book value of assets contributed, and so on. So when you started the partnership, so let's say you and I, we start a dog grooming business together,
Yeah.
and you want to put in 50 grand and I want to put in 50 grand. We have that. And so we both put that in. The partnership now has 100 grand, and your basis in the beginning is 50 grand. My basis in the beginning is 50 grand.
Okay.
And so that represents our investment in the partnership. And now every year your basis is adjusted by contributions that you've made throughout the year, additions like income or tax exempt income, subtractions would be loss or non-deductible loss or expenses, and distributions take out, which would lower. So, if you put in 50
Yeah.
grand, I put in 50 grand, and then throughout the year I took out 10 grand,
Yeah.
that would lower my basis by that 10 grand, right?
Yep.
And so you have your initial, and then those contributions, additions, subtractions, distributions, and that gives you your capital account. And then you would add your share of liabilities, whatever that could be.
Yeah. So we got our 100 grand,
Yeah.
and we also went and got a loan for another 100 grand, right, to buy some equipment or a van or whatever for our dog grooming business.
Yeah. And then so let's just say we're 50-50 all the way through.
Yeah.
And so then we add those share of liabilities, and so now our tax basis is 100 grand each.
Yes.
So that would be our tax basis at the end of the year, assuming we didn't have any income or any expenses or whatnot. And so the reason why you need to be calculating your basis every single year is because your basis cannot go below zero. And your losses are generally, you can generally capture your losses on your 1040 as long as you have enough basis for those losses.
Yeah.
So there's 4 hurdles that you have to kind of jump through to actually capture that loss on your 1040. That's a topic for another episode. But
Why do I want to capture a loss?
So good question. So let's say a lot of people, especially when they're starting out a partnership, they don't dive in. They don't just quit all their jobs or whatever.
Okay.
They could have income from a ton of other sources. And so let's say you have a W-2 job that you're making 100 grand. Let's say you got some interest, capital gains, some dividends of 50 grand, let's just say.
Mm-hmm.
So now you're at 150,000 of income.
Okay.
But let's say your partnership, you get into this partnership and you put a lot of money into this partnership, and you actually, your share of the partnership, let's say the partnership has a loss that year.
Yeah.
And let's say your share of the losses is 50 grand.
Okay.
So without the partnership losses, you would have to be, let's just say excluding like standard deduction, itemized
Sure, yeah.
deduction or whatever,
Yeah.
just for simplicity's sake. You have taxable income of 150,000. Well, now when you can take in your partnership losses, that 150 goes down to just 100. So it can really help
Right.
out a lot.
So now I'm only being taxed on $100,000.
Yeah, exactly.
All right.
So, which is really nice. So another reason why people love these partnerships or flow-through entities is because you can capture those losses on your specific 1040 on your personal return. Whereas if you had a C corp and you had losses on your C corp, you can't take that anywhere. It just stays with the C corp to be used up. In later years, it becomes a net operating loss at that point.
Right.
But for a partnership, you can take those losses and offset other types of losses.
Awesome.
So,
Okay.
or I guess maybe I misspoke because of the interest and capital gains. It depends on how your partnership is, if you have passive or whatever. But
Yeah, I was going to say, I mean, that is a thing that if it's passive or active, there are some different rules on how that's treated. But you're right. It can be really beneficial to take these losses, and due to tax laws and rules, there's also a chance that your partnership could be actually cash flowing income, right? On a cash basis, you might say, hey, we've got income, but on a tax basis, we've got loss. So that's kind of the sweet spot, right? You can be theoretically bringing in money and reporting losses.
Yeah.
And then you're really doing well, right? That's the goal. That's the dream right there. So
yeah, it depends on how things are played out. And
it totally does. Yep. There are lots of ways that can prevent that from happening, or rules and all sorts of situations. But you want to capture these losses, because at the end of the day, they will reduce your taxable income and your tax liability and keep more income going to places you want rather than to the IRS.
Yeah. And a good thing about partnerships is we kind of talked about it briefly. Your share of liabilities go into your basis. That's something that's a big difference between partnerships and S corps. S corps we'll be talking about, like I said, in the future, but partnerships have that share of liabilities that go into their basis. S corps, it's not so as much. There is, again, getting into the weeds a little bit, but there is an S corp debt basis, but there's specific hurdles for that.
Yeah.
But generally, on an S corp, your S corp basis is not affected by the liabilities that the company has. So yeah, so just general overview of basis and loss capture. There's a ton of other stuff that we could go over, but yeah. So that's a reason why you want to keep track of your basis, and why loss capture is so beneficial for people.
Yeah. Two of the biggest things that an individual can do to affect their basis, right, is contribute assets or distribute assets.
Yeah.
Right?
Yeah, and that's something that you have more control over.
Yeah.
You might not have so much control over like the income in it.
If you make money or not.
Yeah.
Right? That there are third parties involved in that.
Yeah.
For sure. Right? But the partner, you can. So I'll just go through this. Contribution of assets. In general, the partnership will take on the carryover basis of the asset. So if I contribute a piece of machinery and I have some, whatever my basis is in it, the partnership now will take that basis. And it's a non-taxable event, right? It's not a sale from me to the partnership. It's a contribution. Nobody's picking up income or loss at that point.
Correct.
Same thing with distributions. If I then distribute that equipment back to myself or to another partner,
Well,
Again, this is very high level.
this is very high level. Typically, distributions and contributions are non-taxable events. Now, there are tons of things that can happen when especially real assets are contributed and distributed from partnerships. There can be some funky things that happen with the tax rules
yeah. If you have if you have an asset that has appreciated in value
from the time that you acquired it. Then all of a sudden there are different consequences.
or if you don't have enough basis, like
Yep.
we kind of talked about, when you have a distribution, then that can become a taxable event.
Yes. But in general, contributions and distributions are non-taxable events, right? So you can contribute, increase your basis, distribute, decrease your basis, and it's not going to cause a tax situation for you that year. Again, this is actually an area where we'll probably go into further detail on another episode, but because it can set up future issues. But especially if you're just dealing with cash, if I'm putting cash in, taking cash out,
Yeah.
like
This is the simplest.
that's the easiest way to think about it. Cash in, cash out. There's nobody's picking up income or expense as a result of that.
Yeah, and that's why a lot of rental properties are set up as partnerships because of these rules, because of these contributions and distribution rules, to where if you have it in a partnership, generally it's a non-taxable event. Whereas if you have it in an S corp or a C corp, you might trigger gain on both the contribution of the asset and also the distribution of that asset.
That's right.
So that's why a lot of people, when they have rental properties, they put it under a partnership because of these contribution and distribution rules.
Yep. And then one thing to remember, if you somehow, take a distribution in excess of your basis, you are going to pick up taxable gain in that case. So that's why it's always important to track your basis and make sure you don't end up in that situation, especially if that wasn't your intent.
Yeah. And your basis should be given to you with your K-1, or you track it on your own.
Really, the onus is on the taxpayer, right, to track their basis.
Right.
And so usually, like here at Larson, for our clients, we track our clients' basis for them. If we have a client who is invested in a partnership and we don't actually prepare that partnership return, we will separately track the basis from our clients' K1s each year, because there can be differences in what your basis is as the partner versus what the partnership thinks your basis is as well.
Yeah,
And
especially if
so-
you've had multiple, like if one firm prepares the business return, 1 year and then they go to another person, if it switches a couple times.
Yeah, or if partners are coming and going,
Yeah.
how that partnership interest is transferred can create differences in what your basis is in that investment, right? So that can be tracked outside versus inside. There's a little nugget, inside versus outside basis. That's a thing. So anyway,
So it's just good to track basis,
yep,
essentially.
yep. It's important. It's got to be done. Really, it should be done for every partnership that's out there. And here at Larson, we're especially as these partnerships get more and more complex, or the larger ones, we usually have complex basis tracking spreadsheets that we do to make sure we track this all accurately. So,
Yeah.
I think that's a pretty good rundown of a partnership.
Yeah, I
And
think
again,
so, too.
we've really tried to stay high level.
Yeah.
We tried not to get too far in the weeds, right?
This has been significantly shorter than the last episode.
Because every single one of these points that we discussed can then be broken down and can get really complicated.
Yeah.
Yeah, there's a ton of things that you can offshoot, on every single thing that we talked about, like fringe cases and specific rules and regulations for each thing. So
Almost every topic touched on could be its own single episode of
Yeah.
30 minutes or more. So
Partnerships are kind of the most. They're the entity type that you can really do the most with.
Yeah.
Right? There are so many different things that can be done with the partnership, and so that's why we decided we had to just go at high level partnership taxation, and then we are going to do additional episodes.
yeah, well, like so coming up with the script or the outline of what we're going to talk about today, these are some of the things that we thought of that we could have talked about, but really deserve another episode, right? We have partnership agreements, active versus passive partners, special allocation, substantial economic effect rules, property distributions in excess of basis, and multiple asset distributions. What happens if you distribute out multiple kinds of assets? Distribution or contributions of assets with built-in gains or losses. What if your partnership is just with your spouse? Step up in basis for purchasing partners. That's a really big one. And also like talking about fringe benefits. So, and that's not even everything. So there's a ton of things.
Like unreimbursed partner expenses, and,
Yeah.
and guarantee.
Inside versus outside basis. That's one that I
Yes,
didn't write down.
Exactly. We didn't write it down. I brought that up. Guaranteed payments.
Yeah.
And we've talked about that in other episodes. Anyway, yeah, there are all these things that could be entire episodes all by themselves, but this is a good overview of a partnership.
Yeah. So just to wrap it up, I think the pros of having a partnership, you have single level of taxation, right? It's only taxed at the individual level. You don't have a restriction on number of types of partners. And we talked about this briefly, a step up for purchasing partners, which that's a whole other thing. Flexible in the allocations of income and deductions. We talked about QBI deduction, qualified business income, and then your partnership debt provides your basis in your tax, or provides tax basis, I should say. Some of the cons, though, some of the things that might make you a little hesitant to have a partnership. You just have tax compliance burdens of filing a 1065, filing another return.
Yeah.
Basis tracking and all of those things.
Yeah. Partnerships can get super complicated, and those, I mean, in my experience, are among the most complicated returns I've had the opportunity to work on here.
Yeah, there's so many moving pieces.
And that's not even taking into account state filings, right? If you're filing multiple states with a C corp, that's pretty straightforward. But if you're filing multiple states, even with an S corp, it's not too bad. Again, because of the pro rata nature of those entities. But then with a partnership and the different types of partners, right? You could have some partners who are being treated one way in one state, and other partners who are being treated another way in that same state, and it can spool into this crazy web of complexity.
Yeah,
So,
special allocations are pretty tough. And like we talked about partnership agreements, that can be worked out in your partnership agreement. But So there's just the complexity of.
Yep.
I mean, partnerships can be simple.
Yeah.
But
It
it's
can totally be straightforward too.
the ceiling is a lot higher.
Yeah.
I would say.
There's just so much you can do that it can just get out of hand
Yep.
very quickly.
Yeah.
Agreed.
So I think that's pretty much everything we wanted to talk about. If you have any more questions or if you have more topic ideas, please reach out to us.
Yeah. Yeah. Thanks for listening. We'll see you on the trail.
For more information about Larson & Company and other educational material, you can find us at our website, larsco.com, also linked in the show description. For questions or suggestions on future episodes, you can contact us at larsonpod@larsco.com. If you would like to learn more about today's episode topic, additional resources can be found in the episode description.